In this section of the bond syndication practices course, we wanted to look at the actual process of allocation and pricing. So the allocation and pricing follows the launch of the deal. And the launch itself follows the closing of the order book. And it's at this time that the transaction size is determined and the final spread is announced. And the spread that we're referring to there is the basis points difference between the yield on the underlying government benchmark over which the deal is priced and the yield of the new issue itself. And in terms of sequence, we have the deal launch and then the deal allocation process. And each underwriter and bank will have an allocation policy in place, and this governs items such as the process for handling proprietary orders, and in general outlines best practice, avoids conflict, and ensures compliance with regulation and policy. And book runners will generally make an allocation proposal to the issuer, which the issuer can change depending on its own preferences, or it can help more or to a greater or lesser extent than it wants to in the process. And we'll go on to that in subsequent slides. And then once the allocations are finalised and distributed to investors, we come to the deal pricing process. And at this point, the coupon and the issue price is determined. Prior to the allocations, the investor orders will sit in the order book, and this is a joint order book. There's full transparency amongst the book runners in terms of the order book. And that order book will have been reconciled by the joint book runners to ensure that there are no duplicate orders in the book that could cause a problem later down the line. So if we take a look at the considerations that might be included when considering what allocations to give investors, firstly, it's usually the issuer's desire to target a specific investor group. So, for example, the long-term investors, or as we would call them in the market, the buy and hold investors. Those are the investors that take the bonds, lock them up and keep them really until maturity. So very little sort of secondary trading. You do want to see a little bit of liquidity in the deal. So they will also allocate to some of the sort of what we would call faster money. Also, two preferences is given to those investors that have actively participated in the process. So they've given good colour during, for example, a roadshow process or on an investor update call. That colour is key to ensuring you get the deal correctly priced or at the right price. You may also consider investors that have had a history in investing in previous issues of the issuer or in the sector in which the issuer operates. And then lastly, you want to avoid investors who have a history of flipping the bonds. And these are investors that come into the transaction, get an order, and then sell it out into the secondary market the next day or within a few days, which puts downward pressure on the price of the transaction. So is not good for the issuer if it trades in the secondary market and falls below the sort of issue price, because from an issuer's perspective, you're wanting to see a good performance because that helps their ability to come back into the market at a later stage. So in terms of the allocation process itself, as mentioned, the lead managers will work to produce an appropriate allocation proposal for the issuer. And as mentioned, borrowers may choose to rely entirely on the syndicate allocation proposal. They may make suggestions or amendments to that, or even elaborate their own allocation plan. But either way, what's important is that the lead manager will review the draft allocations with the issuer or the borrower, who will have the final say in the allocation process, because after all, it is their deal. So they're the ones that want to ensure that it's a good deal so that it trades well in the secondary markets and that enables them to do future funding. And in a few instances, you will see frequent and sophisticated borrowers may actually choose to allocate the order book by themselves. I would say that in my experience in Asia, that didn't happen very often. It was more a case of the issuer taking the considerations of the book runners themselves. And then most importantly, lead managers or book runners should keep a record of allocation decisions and should be able to explain any individual allocation decisions to their regulator on request. And on that point, one thing I would say, and has been a development during my time in both Europe and Asia, is the increased regulatory oversight of the allocation process. So in terms of the process, the salesperson should not actively participate in the allocation process. They can give colour to the bond syndicate desk, for example, around what the investors are thinking, what their previous participation have been, but they shouldn't give suggested allocations to the bond syndicate team. And again, allocations should not be driven by the client profitability, but they should be looked at in accordance with the merits of the deal that is being allocated. Forbidden practices there include laddering, other quid pro quo arrangements, and any spinning arrangements. So basically, this is, if you take the first point of laddering, what the syndicate desk shouldn't do is make tacit agreements with an investor to buy additional bonds in the secondary market in exchange for getting a good allocation in the bond issue that is being announced. And there shouldn't be any other sort of quid pro quo arrangements there. And on the last point there, with regards to spinning, allotments shouldn't be conditional upon any other compensating benefits. So if we look then at the pricing will occur after allocations have been communicated to investors. The pricing call will be arranged between the issuers and the book runners and any other interested parties. And this could include a guarantor if there's a guarantor on the transaction. The legal team usually participate in that process as well. And it's led by the bill and delivery bank. So this is the settlement bank. One of the book runners will have been given the task really of documenting and arranging the settlement of the deal. And it's that bank that organizes the call on the day of pricing. And as mentioned, the pricing call will be arranged between the issuer and the book runners and any other interested parties. And the first part of this call is to determine the terms of the transaction. So the maturity date is agreed, the settlement date is agreed, the issue size would have been agreed on the launch, and then the proposed coupon is agreed between all parties, and any other key terms of the transaction are confirmed. Now, once this is done, what the book runner will do, or the bill and delivery book runner, will arrange for their benchmark secondary trader to come onto the call and spot the underlying government treasury security. So that trader will consult its Bloomberg screen, for example, and quote the yield and price on the underlying government security. And that enables the bond itself, the new issue bond, to be priced. So once the issuers and the book runners have agreed the proposed coupon, issue price and other terms, the deal is effectively priced, and that the details can be distributed through to the investors. And at the same time as given to the investors, the book runners will also notify the financial press, so the sort of Reuters, Bloomberg, IFR, etc., as well as any other parties involved, such as the clearing agents that will be involved in the settlement process. And then usually a round of applause at the end of the pricing call. And then just to finish, if we look here at an example of a pricing message that would be sent out to the investors and to the street. So here, obviously, you've got the name of the issuer, you've got the rating, the size, and the dates. In this case, we've got a 5-year deal, so the maturity is the 12th of April 2026, and it'll be a straight bullet, so the settlement will be the 12th of April 2021. And the coupon is set here at 2.875% and will be paid semi-annually. This is an SEC registered global, so they're generally paid semi-annually on the 12th of April and the 12th of October. The issue price is set at 99.884. It's customary to have 3 decimal points on your issue price, and that is the price at which the investors purchase their allotment securities. And in terms of the spread of 125 basis points is the difference between the yield on the underlying benchmark bond, so in this case the US Treasury, the 5-year US Treasury, which is set at 1.65%, and the yield on the bond itself, which is set at 2.9%. So the difference there being 1.25%, which is equivalent to 125 basis points. So that's essentially the pricing. One thing to add there, the coupon is usually set at the nearest eighth below the yield. So if you look here at the yield is 2.9%, so the nearest eighth below that is 2.875%. So that's how they set the coupon rate. And once all those details are confirmed on the pricing call, as I mentioned in the previous slide, it is ready to then be disseminated to the investor base and to the public, and your deal is essentially priced.